Welcome to another edition of Selling Life and Annuity. I'm Tim Luby. I'm the National Sales Director for Annuities, Core and Marketing. And with me today is our Regional Vice President for Debt Elimination Programs, Paul Bechtold. And our topic today is the perfect storm of a lapsed life insurance policy. So Paul, that sounds pretty onerous. That sounds ominous, sounds scary.
It can be.
A lapsed life insurance policy.
Absolutely can be. That's correct. That can have multiple different consequences, and the first thing people often think of is, okay, well, policy's just gonna go away. We can get another one, right?
But that's not true. It doesn't just go away.
No, sometimes it can. If it's a term policy, we might be able to pick up another term policy. But the first thing you got to do is be insurable. You have to have the. You're not just buying it with your money, you're buying it with your health as well, right? So you have to be insurable in order to get another one. But in particular, what I'm kind of getting at more with this subject is permanent policies. There's a lot of dangers and consequences that go with a lapsed permanent policy, okay? And usually the nexus of that is that wasn't properly designed from the beginning, and it wasn't funded properly in order to prevent that from happening.
Right. So it's not as simple as just getting another policy because of insurability and some of the other things that you've just mentioned.
Correct. And, obviously, over a period of time, cost of insurance is going up. And if enough time has passed, that same premium may not buy as much death benefit if there's structure for a death benefit need.
So it's not just the loss of the death benefit. It's also a lot of the other things that are current or guaranteed in the policy.
Correct. So let's go through a little scenario here, because this is what I really want the agents watching today to really take note of. Let's just say we have somebody that's bought a permanent policy. In most cases, when we're selling permanent insurance, we're usually doing it for an accumulation play. We're doing it for a retirement planning type of benefit. And let's just say that's in an IUL. So we funded premiums into a policy over a period of time. Maybe we've turned an income stream on it for 20, 25 years, and the policy wasn't structured properly for maximum cash accumulation, or the client didn't fund it as planned. That's the other side of the equation. There's always just delinquency on either the client or the agent. It could be either one or a combination of the two, okay? But once we start taking loans from the policy or withdrawals from the policy, and we're not funding it anymore in the future, like what we might do in a retirement planning scenario, if it becomes underfunded and we get enough 0 years in a row, in the case of an IUL, or we don't get policy performance, right, and now the policy runs dry of the cash value, now all of a sudden the client gets a notice one day that says, hey, you're going to need to put more money into this policy, at a point that they may not have the money to put in the policy, okay?
So is this one of the most common ways that you're seeing?
This is a very common way. Okay. The second thing is, because that it's now underfunded. Now, if they were using it for a retirement planning scenario, they have a loss of income, right? But at a time where they have a loss of income and may not have the money to keep the policy in force, if the policy actually lapses, now there's tax due at ordinary income rates in the year that gain above cost basis was received. And that can be a very ugly conundrum of events that I just described there, all coming together at once. Plus, at the same time, now we don't have life insurance anymore at a time that they may need it the most. So does that kind of make sense?
Yeah, that sounds ugly. So you're saying in the year that becomes a thing. So they could have been taking income for 10 years, and then policy, for whatever reason, lapses, and then they get a tax bill for everything that they received for all 10 years?
No, anything above the cost basis paid in. So
basis,
if they
right.
paid $300,000 in, but they've taken $400,000 worth of withdrawals or loans from the policy, okay,